Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. The concept of cyclical stocks will come up often when you read about investing. But what does the term actually mean, and what would be a good couple of local examples? In the past week, updates from Sappi and Sibanye-Stillwater gave us insights into not just two unrelated cycles, but also what life is like at completely different stages in those cycles. Buckle up. Like all good cyclical stories, you are in for a wild ride. In Sappi's case, they are dealing with a weak market and a spicy balance sheet that is causing more than a few additional grey hairs, with banks having to give them some breathing room around covenants for at least the next year or so. At Sibanye-Stillwater, where honestly it's a miracle if anyone has any hair left after what they've been through with the post-pandemic PGM price unwind and the floods in the US, their share price and their earnings are both shooting higher. The performance over 5 years is actually remarkably similar at the two companies. Sappi is down nearly 17% over 5 years and Sibanye has lost nearly 20%. But their path to get there is completely different, with Sappi having climbed from around 27 Rand to over 60 bucks a share before plummeting to the current level of around 22 Rand 50. At Sibanye, they went the other way around. The share price fell from 57 Rand to around 14 Rand before recovering to the current level of around 45 Rand 70 at time of recording. In both cases, anyone holding over 5 years is bitterly disappointed, but also in both cases, there was clearly money to be made, with opportunities to double and even triple your money in a short space of time. This makes it worth understanding more about how these cycles actually happen. Let's talk about the ingredients for a cyclical business. Sappi grows trees and then turns them into paper and related products. Sibanye-Stillwater digs holes and then they extract PGMs and gold out of the ground. Well, that's what Sibanye does for the most part. They also have all kinds of other commodity recycling and similar businesses, but those play very little part in the share price moves. Anyway, you get the picture that these two industries have very little in common. Or do they? You see, the magic of cyclical sectors is that they have similar key characteristics, even if the underlying products couldn't be more different. The main thing to understand is that demand and supply may come in waves, but those waves don't necessarily arrive at the same time. It's easier to use Sibanye as an example, particularly as the full value chain has cyclical plays like the PGM miners and consumer discretionary plays like the car manufacturers who would be Sibanye's eventual clients. There's an element of cyclicality to the car manufacturers, but not to anywhere near the same extent as the miners. Let's unpack why this is happening. For a car manufacturer, demand will have stronger times and weaker times, sure, but people still need to get around. They can delay their purchases, they can buy a cheaper car, but they are unlikely to just avoid car ownership altogether. There is a structural underpin to demand based on the need for mobility. Once the car manufacturing plant has been built, it is fairly straightforward to either manufacture a greater or fewer number of cars in response to either stronger or weaker demand. The supply has some flexibility to respond to demand. Sure, earnings will be impacted by factors like manufacturing throughput and overhead absorption, but you're unlikely to see incredible swings in profitability and massive mismatches between capex and revenue. Well, that's only true in the absence of widespread disruption to the sector at least, which is something different to just usual supply and demand forces. Now let's go further up the value chain and consider the PGMs, a key raw material for catalytic converters and thus internal combustion engine vehicles. Sibanye-Stillwater and the other companies in the sector cannot just wake up one morning and press a button and meaningfully increase production that day. They first have to invest a fortune in building the mines and then expanding them as the resource is used up. To add to the problem, it takes a very long time to get approval for new mines and to actually build them. No matter how much money you throw at the supply problem, there are constraints that are simply a reality of time, environmental authorizations, and all sorts of other things. This means that in a time of high demand for PGMs, Sibanye and the broader sector may not be able to respond with higher supply. This drives prices for PGMs higher, as car manufacturers are willing to pay more to ensure that they can meet demand from their eventual customers. The car manufacturers can just upgrade their production lines or run the factories for longer when consumers want more cars. But PGM miners cannot build mines quickly enough, and that is the core difference. Demand in excess of supply therefore drives the prices of the PGMs themselves higher. After a while, the price of PGMs will be high enough that mining houses can say, hang on, this looks great, They pluck up the courage to invest more capex in increase in supply. As that supply starts to come on stream, prices of PGMs then begin to fall. This can still be profitable for everyone involved, provided that demand for cars remains strong enough to support PGM prices at a sustainable level. And this is where things get very interesting. Cars may not be a hugely cyclical industry, but they are consumer discretionary goods, and they will experience demand shifts based on expansionary and recessionary economic environments. As economies slow down and car demand follows suit, PGM demand drops and so do the prices. Suddenly, all the extra capacity in the market is a problem, because PGM prices are then too low for the mines to be profitable. Mining houses then pull back on supply in the hope that PGM prices start to increase, and so the cycle starts again. Now, you could just as easily apply this logic to Sappi, but it's harder to understand because the paper sector is so much more complicated than the global car market. Aside from economic activity as a driver of demand, there are other complexities like structural declines in certain types of paper. There's some element of this in vehicles as well, by the way, due to the debate around EV adoption, that's electric vehicles. But the penny does seem to have dropped that EVs will only win a portion of the market rather than the entire thing, and this leaves space for demand for PGMs. But where are the profits made in this cyclical pattern, and when is the right time to invest? Get the Top Gun music ready. When cyclicals are doing really well and the PE is unwinding at pace thanks to great earnings, in other words, there's a low PE, you're on the highway to the danger zone. Kenny Loggins warned us, the further on the edges, the hotter the intensity. I don't think he was sinning about mining and paper stocks, but he may as well have been. You see, in non-cyclical stocks, a low PE multiple gives you a margin of safety. You have to be super careful that earnings aren't about to collapse and that perhaps that's why the multiple is low. But on average, low PEs are what value investors get excited about. High PEs are a worry, as this means that a lot of growth is baked in and the potential for disappointment is higher. Because of the nature of cyclical industries, earnings can vary dramatically from one year to the next. The market is even more forward-looking than usual when it comes to these stocks, which is exactly why PGM stocks start rallying as soon as the PGM price moves higher. In fact, these stocks were shooting the lights out while simultaneously releasing horrible numbers for the year ended June this year, as much of that period still had terrible PGM prices in it. This means that a low trailing PE during a period of strong earnings is actually a huge red flag, because the market is looking at this and saying, well, we're very concerned that earnings are about to collapse. So the forward PE multiple that uses expected earnings is actually very high. It's just masked by a low trailing PE. The rule of thumb is this. In cyclical businesses, a high PE is usually assigned to start paying attention because the stock may actually be a buy, because trailing earnings are depressed, and so is market sentiment, with the value starting to reflect the underlying infrastructure in the group rather than its earnings. Patient capital is then required because it is almost impossible to pick the exact bottom of a cycle. If you can do that regularly, you will be very rich indeed. Being early is unfortunately as bad as being wrong, particularly if you are many years too early and you just end up with really bad returns over a long period, even though all the return was made in a short space of time within that period. But if you can afford to go sideways for a while, and if you're not too early, then watching your money double or even triple is highly satisfying. I've clearly left money on the table in Sibanye-Stillwater, but I was still happy to get out when I did in recent months. And well done to those who have held on. As for Sappi, I'm keeping an eye on it. The guidance is that earnings will get worse from here, so I'm in no rush on this one. But at some point, as cyclicals always do, Sappi will dish up an opportunity for the brave. That is exactly why the long-term chart looks the way it does. These cycles play out at Sappi over and over and over again, just like they do at almost every other cyclical company. The one exception, of course, is when there is a structural decline in demand and the market just washes away when there's disruption. Diamonds, I'm looking at you. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.